So good afternoon and welcome to our Financial Planning for Folks with Disabilities info session with Marissa Watkins. So before we begin, we would like to acknowledge the land that we are all living and working on. Although we are gathering virtually, please take a moment with me to recognize the land that you are joining us from today. Acknowledgements are a part of the reconciliation process. Acknowledging the history of the land builds mindfulness of our present relationships with it and with each other. The region of Waterloo is situated on the land traditionally used by the Haudenosaunee, Anishinaabe, and neutral peoples. We acknowledge the enduring presence and deep traditional knowledge and philosophies of the Indigenous people with whom we share this land today. So again, if you'd like to ask any questions during Marissa's presentation, please use the raise hand feature or just wait for a break in the conversation and you can speak up at any time. So a little intro about Marissa. Marissa Watkins is a professional in Waterloo. I'll just ask that people can mute if they get a chance. Thank you. Marissa Watkins is a professional in Waterloo region, working as a senior consultant with IG Wealth Management. After graduating from Conestoga College, sorry, I have folks calling me. After graduating from Conestoga College with her Bachelor of Public Relations degree, she knew that she wanted to work with people in her community and build connections through communication. After seeing firsthand the impact that financial planning has on so many people, Marissa worked hard to earn her mutual fund certificate and life insurance license so that she could help young professionals invest in their futures. With the great mentoring of a certified financial professional, it was a great honor and ease that Marissa took on a consultant role in 2022. Marissa knows how important it is to deliver superior customer service and customized planning for each and every client or prospective client that she meets on her journey, and she looks forward to meeting new people along the way. So Marissa, I'll let you take it away.
Awesome. Thank you so much, Sherry, for that introduction. And thanks for having me here today, everyone. I am going to be going over a lot of information. I will be providing my contact information at the end if any of your questions don't get answered or you don't feel comfortable asking them during this presentation. So don't hesitate to reach out. And as Sherry mentioned, any questions that you want to put in the chat, put up your hand or come off mute, feel free to do so, okay? I'm going to pull up my presentation here today. And let me just make sure I'm all set up. Beautiful. All right, so we are going to be talking about financial planning for folks with disabilities. This could be yourself, this could be loved ones in your family, or both. And I'm just going to go over kind of the gist of what we're going to be chatting about today, okay? So we're going to start out with saving for your futures. So whether you're supporting yourself or a loved one, it's kind of easing the uncertainty of your financial future that you may find moving forward. We'll talk about potential saving strategies, reducing the taxes that you pay, and then to ensure that you and your loved ones are cared for, we'll discuss how you can protect those you care about through insurance, estate plans, but that'll just be a really short portion at the end of my presentation today. Secondly, it kind of goes hand in hand, but we will be talking about ensuring you and your loved ones are cared for. And then I'll give you my closing thoughts and kind of next steps for you and what that looks like as well. So we're going to start off with saving for the future. So one of the key things is the disability tax credit, which I will go into more depth as we move through the next couple of slides. One of the things I did want to mention here before I hop into the disability tax credit is the child disability benefit. So if a child is under 18 and qualifies for the disability tax credit, they may also be eligible for this child disability benefit as well, a supplement to the Canada Child Benefit and Children's Special Allowances payments. It helps low and modest income families who care for a child under age 18 with a severe and prolonged mental or physical impairment. To apply, families must obtain a document, obtain a signed disability tax credit certificate, and the application form for the child. However, you can request up to 10 years back as well, and this is all based off of when you got a medical diagnosis from a doctor that you are currently or were disabled within the past 10 years. These deductions and credits may be available to you if you support an individual with a disability as well. So there are also many advocacy programs, whether charities or nonprofit organizations, such as Independent Living Waterloo Region, that may focus on particular illnesses or disabilities, and they're often great resources as well. On the next few slides, I will go into more depth about the disability tax credit, as I know that that is a big chunk of why we're here today, as well as the registered disability savings plan. So the disability tax credit reduces the amount of income tax that a disabled individual must pay. To receive this credit, a disability tax credit certificate must be completed and signed by a qualified medical doctor, optometrist, audiologist, occupational therapist, psychologist, or speech language pathologist, and then returned to the CRA, the Canada Revenue Agency. It's important to note that some medical practitioners may charge a fee to sign this form, so that's important to consider while you're going through the process. If you get denied this credit, there's no harm in trying again. And something that we see in a lot of unique cases is they'll go to their general practitioner and get denied a signature. It's very important that you go to a specialized doctor and continue to reapply if you don't receive the benefit at first. Often people try once and then they don't try again, but it really is worth putting in the time and effort to see if you'd like to move forward and just continue on. A couple of things here. Like I mentioned, you can apply retroactively to a max of 10 years. So that would backdate to when you were diagnosed by a doctor, not the date of your application. So that's really important to consider when you are applying for the disability tax credit. It can go back to the diagnosis date, not the date of your application. And most people make that mistake as when they are applying for this credit. Now I'll move on to the registered disability savings plan. And this is a long-term savings plan for a person with disabilities that provides assisted savings from the government through grants and bonds. And it's also a tax-deferred investment growth. So what that means is you put the money in now and you don't have to pay tax on it until it's withdrawn, which is typically throughout retirement. One thing that is important about the RDSP is you do need to have a disability tax credit in order to open up an RDSP. So they go hand in hand. Some things about the basis of how an RDSP works. So the person who opens the plan and makes decisions about the plan is called the holder. This can be the disabled individual if that individual is of the age of majority and has the legal capacity to handle their finances. Otherwise, depending on the beneficiary's age at the time that the plan's set up, the holder can be a parent or a legal guardian as well. The holder determines contribution amounts, selects investments, and manages the withdrawals from the account as well. The beneficiary is the person who will receive the funds in retirement. Who are eligible holders? So there are a couple of different people who can be the holder for the account, as I mentioned in the last slide. If the beneficiary is a minor, so under 18, the holder must be a legal parent of the beneficiary or someone who's legally authorized to act on behalf of the beneficiary. Although, as mentioned before, if the beneficiary is mentally capable and they are an adult, the holder must be the beneficiary. It just keeps everything a little bit easier than going through a third party to retrieve funds, change your investments, and then begin withdrawing funds at that time as well. Other than that, I'm just grabbing this here. If the beneficiary is an adult whose capacity is in doubt, you can have a holder who is a qualifying family member. And this has to be someone who is either currently cohabitating as a spouse or a common law partner and or your legal parents. There are a couple of different options as well, exceptions to those rules, but those are the main people if you are an adult who doesn't have the capacity to be your own holder of your RDSP account. Now, who is the eligible beneficiary? So as I previously mentioned, it has to be somebody who is eligible for the disability tax credit. I'd say the first four are pretty common sense here, but we have to be a resident of Canada. You must be turning 59 or younger in the year that you open up the RDSP. You must have a valid SIN, which I hope you would if you are a resident of Canada. And if you don't already have an RDSP, you can only have one per Canadian. So if you have one elsewhere, there's no point in opening a second one at a different financial institute. Now I'm going to go into the government grants and bonds. So these ones get a little bit confusing because it's all about dollars and cents and kind of the income that you're bringing in as well. So the Canada Disability Savings Grant is a matching grant provided by the government up to a lifetime amount of $70,000. Now, I am going to show you another slide I have here. Sorry, I didn't provide this earlier, Sherry, but I think it demonstrates kind of what I'm talking about here a little bit better. So if your family income is lower than this $98,040 here, you can contribute $1,500 a year and receive $3,500 from the government based on your income level. So as you can see, this is 300% of the first 500, 200 on the next 1,000. Not important. What I like to tell people is it's basically 3 to 1. You put in $1, you get $3 back from the government. If your family income is over that $98,040 threshold, you get 1 to 1. So you put in $1,000, you get $1,000 matched from the government. Okay, I'm going to go back to where I was here, pull this back up, and I'm going to move on to the Canadian Disability Savings Bond. So this is available to Canadians with a low or modest family income. So the bond can be added to the RDSP even if there hasn't been any contributions. So if your cash flow is lower, this is one way to get funds from the government without contributing yourself. The amount payable also depends on your family's income, and these bonds are payable until the end of the year that the beneficiary turns age 49, which I will go into detail later because it is important. It is important that no matter what you know, the RDSP is solely for retirement. Anytime you take funds out before the age of 50 or 60 typically, you will have various repercussions from the government, and they actually take back more than you would expect to withdraw these funds. So it's really just important to note that whenever you open an RDSP, it's not for emergency funds popping up, it's not for things like that, but there are a couple of other options which I'll go into that will allow you to still get your ODSP while saving for your or your loved one's futures as well.
So Marissa, we do have a question.
Yeah.
If we ask that question, yeah. So
Of
Roberta,
course.
would you like to ask the question?
Yes, is this only available to people who are under retirement age?
Yes. So in order to open up the RDSP itself, you have to be before the age of 49, Roberta.
49, okay.
Yes. And the reason for that is there's something that I'm going to talk about called the 10-year rule. The government stops contributing at the age of 50, and you have 10 years before you can start withdrawing those funds out of the account.
Okay.
So that's where they kind of get you if you are closer to retirement age, which is why it's such a great product if you know about it, but not everybody knows the benefits of an RDSP. They aren't necessarily talked about. Normally only the government kind of ODSP versus RDSP tends to be the common topic of conversation.
Okay, thank you.
That's not to say, Roberta, that there aren't other options that we could look into, or, every situation is very different. I find that with any financial plan that I do, but especially with disabled folks, because everyone has a different situation with their income, their level of mental capacity, what they can and can't do in regards to their finances. So we could always have a chat afterwards as well, if you're interested in looking into that.
Okay, thank you.
You're welcome. And if there is any other questions, I can't see that on my end other than this here. So feel free to just pop up if you have anything. Okay.
I think Randy has a question. Randy.
Okay.
Hi. Maybe you haven't gotten to this point yet, so I apologize if I'm preempting you, but I do have a Canada Disability Savings Bond, which will, I guess, I'll turn 59 in 2 years. So I guess it's the year you turn 60, you can start withdrawing money, or like I did cut off at age 49 or whatever.
Yep, so that will come up. It's the 10-year rule, but yes, age
Yeah.
60 is typically when you can start withdrawing funds from any of your bonds or grants that you've received from the government.
Yeah, and are there is it something where, okay, say I need a big chunk of money, right? Because can I take out the entire amount at that point? Or like, how does that work, the taking it out?
Yeah, so as far as I know, they're taxable. So that's the main thing about taking out a large
Yeah.
chunk of the funds. So
The bond is taxable, right? Like,
yes, yeah,
not
when
the
you
money
take
you
the funds out.
contributed.
Exactly. You are 100% correct. So anything you've contributed, you can take out tax-free. So you're still getting that tax deferred option because say you worked your life for a portion of your life, you would have had a higher tax rate than when you are getting towards age 60, right, Randy? So typically that's where the tax deferral comes in. So you're still paying tax and it does become income when you take it out. Now, I'm not 100% sure about a lump sum versus like set payments, but I would be happy to take a look at that and just send you an email afterwards. It may come up in the slides, but I don't think I personally have dealt with that yet. I have a lot of people who are around your age who are just starting to get to that point as well.
Okay, thank you.
Yeah, you're very welcome. Okay. Next up is just a final note, which we were just chatting about, which is beware of the 10-year rule. So this is where I talked about, it's called the assistance holdback amount here. Basically what happens is all federal grants and bonds paid into the RDSP in the last 10 years would be pulled back. Three times the amount withdrawn would be pulled back if you don't wait the 10 years in between when you stop contributing and when you start withdrawing the funds. So in Randy's position, if he stopped contributing at 49, he's almost past that 10-year rule now and will be able to start those payments or withdrawals to himself. Some or all of this holdback is paid if a withdrawal is made, right? If the RDSP itself closes or if the beneficiary passes away. Amount repayable on withdrawals is lesser of the full holdback amount, or as I mentioned, 3 times the amount withdrawn. So that's why it's very important to wait until you're 60, because say you do make more than 98,000, so you are above that threshold, and you put in $1,000 and you get $1,000, they're still going to take 3,000 if you were to withdraw 1,000 out before the deadline. So a lot of people don't understand the importance of that. Like, this is a very, very good retirement tool, but not specifically for day-to-day costs. This is going to be a little shorter of our presentation today, but it's always important, especially in my field, my industry, to ensure that you and your loved ones are cared for. So we talk about quite a few things with my job, including your estate plan and tax planning. Not always the funnest things to talk about, but they're definitely important matters to take into consideration. So I'm just going to do a quick overview of this. One being your will. So there are a couple items here that you want to take into consideration. Who would be the executor? So this is someone who actually handles your finances, your probate, everything that occurs after you pass away, including all of your accounts. So handles those accounts. Who should have guardianship of children if you do still have minors? And then also discussing the considerations about a trust for a disabled child, if that is the case in your situation. You also want to consider putting on a power of attorney for a couple of different things. One being for property. So who will look after your finances if one or both of you or your spouse lose capacity? Will this person have the authority to make generous support if you do have a disabled loved one or child in your household? And then finally, your healthcare directive. So I think we can all agree that this is a really important person to have and to have conversations with as well, because you don't know what's going to happen. I think COVID has really shown us that in the past 3 years. So who would you feel comfortable with making those decisions about your medical care if you were to lose capacity? So all very important parts of building up that estate plan so that when you pass away, your loved ones don't have to worry about a couple of these items. They know what your wishes are moving forward. There's a couple other ways to leave assets either to disabled family members or just to family members. So I'm going to go over a couple of those things. The first one being leaving assets to a third party with an unstated expectation that he or she will do the right thing. Now, the key thing about this is your expectation may not be enforceable. We know that relationships don't always work out the way that we expect them to. And they may also be considered assets for social assistance purposes. So that is one route to go to leave your assets to a family member. The second way would be to leave assets directly to the family member. Potentially, this may not be suitable if they're receiving social assistance benefits such as OSAP or ODSP, because, and as I'm sure some of you know, if your assets are above a certain level or you get certain gifts, your ODSP is reduced. So this is an important matter to think about, as well as you must determine whether leaving the money to this family member or child, if they're capable of making the right decisions with it when you're not around. Finally, and I think this is a really important one that not a lot of people know about, are trusts. So leaving assets indirectly to loved ones, and specifically, say you are the disabled family member, this is important for people who may pass away before you, like a parent. And the reason for this is it provides a choice in who the trustee is, when the payments are made. It prevents and reduces social assistant clawbacks because it's actually a formal trust. It does cost some money. You have to go to a lawyer. Typically, I think the fees are between $1,000 and $3,000. It depends on where you live and who you go to. But basically, you choose when all of this is made rather than the government. And I'm just getting the Henson Trust here. The Henson Trust is an effective strategy alongside an RDSP because if this, 1 second here. Yes, okay. You can set up that upon your death where a trustee holds and manages the person's inheritance, effectively moving the legal title of the assets from you to this person without going through the government. So it does not impact your ODSP or any other government assistance that you have. As I have explained, there are several ways to think toward the future for you and your loved ones, what they'll need and how to best set up your plan. So these are just a couple of things that, will assist you in that. But I myself didn't know much about the Henson Trust until I started working here. And I do have some disabled family members who could probably really benefit from that in order to still receive their social assistance programs and payments that they are currently.
So Marissa, there was a question around ODSP limits around assets. And I remember we had talked about that. I'm not sure if that's coming up later in the presentation or if you want. Yeah,
I know we had chatted about it. I don't know. I don't think I added a full slide here.
Oh,
so my apologies there.
I have the numbers here if you want me to just.
Perfect. Yeah, Sherry, if you want to throw that out, that would be fantastic.
Sure. So the question was just what are the asset limits for while you're on ODSP? And so they are higher than they used to be. So the asset ceiling for a single person is now $40,000. And then for a couple is $50,000 and then $500 for each dependent other than a spouse. So 40,000 if you're a single person is the number that you are allowed to have in terms of the cumulative amount of all of your assets that you own. So Perfect. There you
go. Awesome. Is there any other questions, Sherry, before I move on?
I think that's it right now. I don't see any other hands up. Yeah.
Perfect. I also had another note here about the Henson Trust before I move on. So there is a certain amount that you can get just from the Henson Trust you can provide as a gift, but the Henson Trust also allows you an opportunity to get about $10,000 a year out in cash towards different medical expenses. So although someone may have set it up to give you a certain amount per year, you can also on top of that apply to get more funds out of the Henson Trust if you have medical expenses, which I'm sure most of us do, right? And if they go above and beyond for your disability, this could be a way for you to get additional funds for that as well. All right, I'm going to move on to your most valuable assets, which are you, your loved ones, your ability to earn your income. I'd say you and your loved ones are probably a bit more important, that's coming from a financial consultant. But it is something that we always like to discuss. It's another topic that's not always the funnest, but there are a couple key things that I just wanted to bring up. I'm not going to go into detail about them, but some ways that you can kind of make sure you and yourself and your family are protected upon your passing are not only life insurance, which provides a death benefit upon your passing, but there are some things called disability insurance, which helps you pay for your expenses while you aren't working and protects your savings. So this is typically for someone who is working a regular job, does get a disability during that job and can no longer work there. They have a lump sum provided on a monthly basis to kind of make up for that income. So this could be for a spouse, a child, a parent. It's just important that you know the different aspects that are available to you. Another thing that we also look at when we're working on an entire financial plan is your critical illness insurance. So what this typically covers is, the 4 main: heart attack, stroke, cancer, and bypass. There's also additional ones. But what this is you pay a certain amount in monthly, and then if something like that were to happen to you, you receive a lump sum, which you can use at your discretion for whatever you need. So just a couple of key things to keep into consideration. I won't go into too much detail because I could talk for hours about insurance, but nobody needs to hear me talk about insurance for hours. So I will move on forward just to my closing thoughts here. There was a couple things that I just wanted to bring back. One is there is an option upon death to roll an RSP, so that's a regular registered savings plan, into an RDSP. So that would be if a parent passed away and they rolled their RSP into an RDSP with no taxable implications. So although only parents or grandparents can do this, it's another great option to provide funds for the disabled person's retirement without them paying for it themselves. So I wanted to make sure that was all mentioned as well. I also wanted to just tell you a little bit about the rest of what I do here. And it kind of goes over everything that we had already chatted about, but just in a broader picture here. So we focus on managing cash flow efficiently, preparing for the unexpected, whether that's major purchases, health conditions, whatever pops up, planning for major expenditures. That's more of like a house purchase, cottages, things like that. Maximizing your business success, optimizing for your retirement, which is basically what the RDSP is doing for disabled folks, and also sharing your wealth at the end of life. So if you were to want to leave something to your loved ones, what does that look like on top of all of these other things? So a little bit about me, which Sherry already went over everything and she was really great, but I'm a senior consultant. I've been working at IG Wealth Management for 10 years. I started as a high school co-op student and kind of made my way up. I'm really happy to have my own practice now. And I did provide my contact information here. So that's marissa.watkin@igpwm.ca. And my phone number, if you do have any follow-up questions, is 226-444-7727. And that comes directly to me. I also have a brochure if anyone's interested, and I can even send it over to you, Sherry, to provide to the participants. But it just goes over a little bit of what I talked about today in a more branded version of what I've presented here.
Yeah, thanks so much, Marissa. I know I have a couple of questions. So
okay.
Yeah, if you maybe want to, perfect. Stop sharing, that's great. So
awesome.
As someone who has an RDSP, which I do, and I'm now 43. So can you give us sort of what the next like 10 to 15 years is going to look like if someone's in like a position like mine? So I'm 43, I'm reaching 49. What's going to happen then? And then when do I start accessing money? Can you kind of just give us like that scenario?
For sure. And I think the biggest thing here is making sure we're maximizing it in your last 10 years, right? I think going back and ensuring that we haven't missed any grants or bonds from the government is a key thing. They are actually quite good at letting you know if you call them up and say, hey, this is when I was diagnosed. They will be really good at kind of backdating that information. So that would be my first starting point. The second point that I would want to look at as we move forward with your retirement plan would be, are we at the right risk level moving forward? So as you know, you kind of start out when you're young, more aggressive if you're investing, because you have lots of time until you retire. As you get closer to your 40s and 50s, this is when we start moving things over so that they are more conservative. And we have discussions about your income at this time too, because it typically changes as you move towards retirement. And as we get towards that age 60, that's when we want to make sure that most of your funds, not most of them, but a chunk of your funds are in a cash or close to cash position so that they aren't in the markets anymore. So you're not seeing that volatility as you start to take funds out. And then, although I mentioned to Randy, I'm not 100% sure about a lump sum versus those monthly payments. I believe the monthly payments would be the easiest to set up and the least taxable option for you as well. So that's when we would start to look at, how long will these funds last you? Here at my job as a financial consultant, we would go through all of your expenses, all of your other accounts, and all of those types of things to make sure that your monthly needs are going to be met throughout these years. Starting at age 43 is a great time because we can take a look at if there's anything else we need to do to kind of supplement that before you get to 49.
Perfect.
Is that kind of answer your question there,
great.
Sherry? Okay.
Sort of a follow-up to that. I'm not sure if you have those numbers handy, but is there like a maximum amount that you're able to have in an RDSP or a maximum amount that can be contributed or anything like that?
Yep, that's a great question. And I apologize, I did not add that in, but it is the contribution limit from yourself to contribute is $200,000. So, and that also includes, as I mentioned, the RSP rolling into the RDSP, that you can't go over that contribution limit. So say your parents are planning on providing you with, on their passing, $140,000 in an RSP. You'd have to make sure that you don't go over that limit, or the parent would want to ensure you don't go over that limit at that time. So there's a couple of key things to consider, but the main thing is your contributions can't go over 200K, and hopefully they grow past that if you do put in the 200K as well.
Okay, and so your contributions would be 200K. Is there a maximum of the grants and bonds that would be added to
There
that?
is, yeah. So I believe the one is 70,000 for the grants. I'm just pulling that up so I don't provide any incorrect answers here.
Sorry, I put you on the spot here.
That's okay.
Need the specifics.
This was the part I was more nervous about, right? Is the answering of the questions. No, but the grants, so that's a maximum of $70,000.
Okay.
So depending on if you're doing dollar to dollar or $1 to $3, it doesn't impact the amount. So for an example, if you are a lower income and you are getting 3 times the amount, it's still only up to that $70,000 mark. And then the bonds, so these are the ones that are paid to you based on your income, no matter what, if you are low or modest income, is 20,000. Sherry.
Okay, so the government portion would be 90,000. Our portion could be up to 200, and then on top of that is whatever interest accumulates within whatever product you have it in.
Exactly.
Okay,
exactly.
perfect.
Yeah.
Is there any other investments where you can see a 300% return on your investment immediately? Like I just think I can't even think of anything else.
I'm trying to think. I mean, our RESP, so registered education savings plans, you get a chunk, but it's not 3 times, right? So this is, and as much, I would have to say, personally, I don't think there's enough support from the government. So although the 3 times is awesome, I still don't think it's enough, but at least it is, out of all of the other investment options, providing you with that 3 times the income there.
Yeah, no, that's great. It's a really good product if you're able to access it. Randy, you want to ask a question?
Yeah, sorry. Gee, I think I forgot. No, I mean, I was going to make a statement that the 70,000 is not reachable if you're dollar for dollar, because it cuts off at 49, right? So it's only if you're in that lower income stuff. But I did have another question. Sorry.
Oh, no worries.
Sherry, what were you talking about just before? Because that's what triggered me.
So I was talking about like when you can access the money, and then the grants and bond maximizing.
Mhm.
I don't know. So why don't you think about it?
Oh, yeah, no, I remember. It
Okay.
goes back to your statement about the 3 times penalty if you take it before the 10 years.
Mhm.
So are you saying that, well, let's put my example, right?
Okay.
So I put in, I only discovered it or had money to put in it, 7 years before I turned 49. So I got, and I came into some money right at that time, which was, fortunate for me. So I put in a lump sum of $8,000.
Okay.
Because that was my max. And then I got an 8,000 grant. So you're saying if I take out money tomorrow and I try and take out, they could take out more than the grant that they put me, or is that 3 times penalty up to the max of the grant that they gave me in the first place?
So it's a very mathematical equation on our end, Randy. So the first part would either be the full assistance holdback, which is a mathematical equation that I don't know off the top of my head, or the 3 times. So it depends on your situation and how much money you have within your RDSP. But I'd be happy to look at your situation specifically, as I already mentioned, because I don't know 100%. But feel free to send me an email and I can just look over that, send you a follow-up, because it would be 3 times, if not close to that. And that's the unfortunate thing about when some people sign up for an RDSP and they don't understand that aspect. They think they can just go grab the funds whenever they're needed. And that's why I make sure, right, in multiple parts of this presentation that I say, if you don't need funds until you're 60, this is the place to go. The hard part about that is, as Sherry mentioned, your assets can't go above a certain level to not get any clawbacks for your ODSP, right? So there are other options like TFSAs and RSPs and things like that, but if they impact your monthly payments from the government, that doesn't really help you out too much, right?
I guess what I'm just, and I don't know, like I don't have any plans to take any money out, right? But it just seems like robbery from the government if I put in $8,000 and because I need $3,000 right away for an emergency, I'm gonna lose money because they're penalizing me the 3 times amount, right? So
yeah. Well, and I can't say I don't disagree with that, Randy. But there is definitely a negative impact that's without giving you the specific numbers. It will be more than you expect to take out.
I just have to wait 3 more years.
Hey, Wendy has her hand up there.
Okay.
Yeah. Hi. I heard from my financial advisor, or maybe I misunderstood, or I don't know. When you turn 59 and that's all said and done, you have to move your money over to a GIC or a mutual fund. Is that true?
It is already in mutual funds, like as it is, Wendy. So typically, an RDSP is built up of mutual funds within it. So you're either already invested in something like that within your RDSP. What your financial advisor is probably saying is a GIC is a guaranteed amount for you, which you're not in the markets anymore, right? So if you buy a GIC for 3 years, and it's at a 4.5% return, which is similar to what GICs are at right now, which is better than the markets, they will recommend that you put the funds in there so they're not in the markets anymore and they're staying safe, right?
Okay.
So I think that's where your financial advisor is coming from. You don't have to move it from the RDSP to start taking the funds out, but I agree with them. You want to go to more cashable investment options so that you're not losing money as you start to take the funds out.
And my fear of doing that is that ODSP might nail you for it, because that's an asset. That's a huge asset. So,
to like the GIC itself?
Yeah.
So I know here we can purchase GICs within most of our products. I don't know what it's like at your financial institution, and I wouldn't know 100% if that would be the best option, depending on when you're taking the funds out. Like if you want to start taking the funds at 59.
Yeah.
But that is a great question, Wendy, because I wouldn't think it would count as an asset unless you took it out, like moved it from the RDSP into another space.
Yeah, because that's my fear, is that the GIC is going to count and ODSP is going to be like, oh, you have way too much. We're going to cut you off now until you spend it.
That's what I would talk to your financial advisor about. Just say, hey, you know, are we actually moving it from the RDSP? And if she's saying, let's start taking the money out, but you don't need it for cash flow and put it into a GIC, then that's a whole other plan. Do you know what I mean?
Okay, perfect. Thank you.
Okay. Yeah, you're welcome.
Okay.
Yeah, that's a
other
good question.
questions? Yeah, I know.
I have a question. It's not related to the RDSP, but it's financial sort of planning related and something maybe other people have dealt with. But if you have an RESP for a child and that child decides not to use that money, like not to go to post-secondary, what can you do with the least tax implications to turn it into something like maybe for a retirement, or can it be rolled over into an RRSP or something like that? What do you recommend there?
Yeah, so there's two key things to consider there. If you get grants and bonds for registered education savings plans and your child does not go to school, you do have to return those grants and bonds to the government. But you get to keep the entire principal that you put in. So the funds that you put in, you can either roll them over to another child in your family going to school. You can roll them over to an RSP, I believe, as long as you were the contributor and you have the room available in your RSP. So two key things to consider there, but it's just the portion that you put in. There are a couple other options. I mean, you can keep an RESP open for a good chunk of time if you don't know if your child's going to go to school either. So that's something a lot of people don't know, right? Is I think it's 35. You can keep the RESP open until, and then you still have time to make some decisions about those funds as well.
Yeah, that's good. Okay. And in that, so when you say you're repaying the principal, or you get to keep the principal, do you also get to keep any interest earned on those grants and bonds? Like you just have to give them back dollar for dollar, the grants and bonds?
I believe so. Yeah.
Okay.
Yeah. Because any of the interest or, investment return on that is already in the account, right? So I believe that's the case. I haven't dealt with that one specifically, right? But that would be what I've seen in all of my learning, is dollar for dollar back with those grants and bonds.
I just have a teenager who's like, I'm not going to post-secondary. And I'm like,
yep,
you are, but
what happens if you don't? Yeah.
What happens if it doesn't? So
yeah, and I'm just going to point out how that's so different, right? How the RDSP is handled.
Yeah.
Right. Isn't it? So like, and what's behind that, right? Like why is the RDSP so punitive?
I know. I really struggle with that one.
Like if you're in an emergency situation, right? Like, and you need money, why is it so punitive when, they have already another registered plan
Mm-hmm.
where the penalty is nowhere close to what they're doing for the disability plan?
I would agree, Randy, and unfortunately, that's just the product that the government has made available to us, and that's why earlier I said I don't think they do fairly anywhere near enough for the disabled community. But all we can do is make sure that we are trying to use the product they've provided to us in the best possible way, right?
Yeah, for sure. Wendy, is your hand up again, or is that from before? No, you're good. Okay. Just checking. Yeah, so I wrote down, okay, so 49 is when you stop making contributions and then it just stays there gaining interest or being managed, whatever, for 10 years, and then you can start taking the money out.
Yep.
Okay, what happens for some folks with disabilities who maybe have a shortened life expectancy? Is there something that can be done in that case? Do you know anything about that?
I believe there is. Let me pull up my brochure here because I am pretty positive.
I mean, many of us live the same length as our non-disabled peers, but I know there's some folks who do have some shortened life expectancy, and I think it's unreasonable for us to like have money put in, right? And then you can't even access it. Like
exactly. So I just pulled this up here, Sherry,
Yep.
and you are correct. So what you would need is a shortened life expectancy, kind of diagnosis. So that was
Okay.
5 years or less that you have to live. And within that time, you'd be able to repay the amount up to 10,000 a year. So still not perfect, right? It's not allowing you to get everything out at once. But it does allow you to have some emergency funds available to you at the
Okay.
end of life there. And then it
Okay.
would be a decision whether that 10-year rule would be worth it, right? Do we leave these to our beneficiary, or do we take all the funds out right now and take the hit? I think that would be the next discussion if you are at a shortened life expectancy.
Yeah, so in that case, it almost becomes like an inheritance tool, right? A portion of it anyways, yeah, okay, gotcha.
Yeah.
Yeah, it is pretty limited. I mean, there is so many things about it that are great, like the 3-to-1, I love that, but this other part is really, yeah. So I wonder, we need to talk to our MPs, guys, like about this. Like, this product is not the perfect one that they're sort of touting it to be. So yeah.
It's not perfect, but it's there. And as long as you use it correctly and know what the limitations are, hopefully it can aid you in your retirement. And that's all we can do with it, right? But I completely agree, Sherry.
Something that might go hand in hand, guys, with our RDSP conversation is the Canada Disability Benefit conversation we had. So I would love to see people have the opportunity to use, maybe if they don't need it for their day-to-day living, like a portion of that CDB to fund their RDSP, right, going forward. And then that might help them for later retirement planning and being more secure and things like that. So that might be an opportunity as we get closer to the CDB details being flushed out. So yeah. Is there any other questions we have around finances, planning, wills?
A lot of info.
I know the will thing was scary. I recently redid mine and had to do the who's making the decisions and all that kind of stuff conversation. And it's not one you want to have, but it's one that you should. I think it's really important. I recently saw some stats that under the age of 50, I think there's like only 35% of people or something like that have wills. And if you don't, what happens with your money when you pass? Or even if you don't pass and like decisions have to be made around end of life and things like that, I think or whatever care decisions, it's really important that you have, someone, the power of attorney, and you have the medical person lined up. I think these are important conversations, not always comfortable, but important nonetheless.
And they're important so that the person that you do name those things is also aware that they will have, these decisions to make when you pass, right?
Yeah.
I think we see oftentimes people will come to us, they'll have a will and they'll have named an executor or an executrix, but they had no idea. And that's a big responsibility to take on. So having those conversations with your family members are really hard, but they're really valuable so that it takes away a lot of stress at the end of your life, for sure.
I did find it really interesting that you don't have to tell somebody that you're literally leaving them a human. Like, I'm like, what? I mean, I did tell and ask the person, but I was like, how is that allowed that you can just all of a sudden like, oh, here you go, here's a person. And then also the medical piece too. Like it was my brother. I sat him down and explained to him what I would want and what sort of interventions I'm comfortable with and at what point to stop all that. But yeah, I think it's really important to have those good conversations. I think, sorry, who was that? I think James asked a question. So one witness for a will. So, I mean, wills are done different ways. And Marissa, you can maybe speak to this a little more, but you can do them with a lawyer. There's will kits, like there's all different ways to kind of manage it. So
yeah, I mean, I personally, I'm not a lawyer, right? So I'm just speaking off the cuff here, but I would personally recommend going to a lawyer. I know it's a little bit more expensive, but then you're ensuring that you're covering all of the bases. I have seen some will kits online too, Sherry, and I don't know how reputable all of the information is on there. That's why I'm always like, it is a cost, but it's worth it to make sure that you've covered all of the bases for your family and your loved ones and your friends when you pass away.
Or you
And I
could just be like the people on Dynasty and like write it on a napkin or whatever.
I mean, you can do that. Yeah, 100%. But it is, and why I'll just bring this up too, but mentioning it to your family members, for example, if you had like an RSP, a regular retirement savings plan with us here, sometimes we don't have the beneficiary's contact information. So if you don't come to us, the money just sits here, right? Like if we don't get notification that someone passed away and we don't have contact information for the beneficiary, it makes it a really complicated situation. So it's really important to have those conversations as well.
So would you want a copy of wills for your clients? Would that be the best?
Yeah.
I should probably send you over a copy of
Yeah,
mine.
I was gonna say, yeah, like typically we just to have on file. If you're comfortable sending it over, the thing about a financial advisor is the more we know, the more we can help you with.
Yeah,
right?
no, that's good.
Yeah.
We have a couple questions here. So
Okay.
Roberta,
Okay, I have a question about age again. I had my spinal cord injury occur when I was 63.
Okay.
I already had my DTC in place for severe arthritis, but since I've had my spinal cord injury, there really isn't anything else other than a DTC that can help people in the years after 60. There's really nothing available, is there?
I'm trying to think off the top of my head, Roberta, other than, nonprofit organizations and other resources available to you. I don't see anything specific from a financial institution standpoint. That's not to say that there isn't anything. And I don't know if it would be possible I don't know if there would be a benefit to reapplying with your spinal cord injury. I don't know if that would make a difference. In
the amount of my
I think it'd be worth a try, Roberta. That's what I would say. I'm not.
That's 100%. Interesting. So your disability tax credit, when they assess you for your disability tax credit, it's not the same for everybody? I thought it was the same.
Yeah, it's the same for everybody. Yeah.
Okay, so it wouldn't have an impact sharing?
Yeah. No.
Yeah. Okay. I was just trying to throw something
if I remember
out.
Correctly, If I remember correctly on the income tax forms, it actually has it in bold. So it's like if I'm not mistaken. Yeah.
But I do recommend if anybody has ever declined, like denied the disability tax credit, I was like my first year after I was injured, because I just got my family doctor to fill it out. He didn't, I guess, fill it out very thoroughly. And then it was denied. And I was like, I literally have a spinal cord injury. Like, I'm never going to walk again. Like, how much, what more does it take to get the disability tax credit? So my lawyer at the time, as I was going through my car crash, like litigation and stuff, was like, no, you need to reapply. And I did, and was then subsequently approved. But the only time, Roberta, is if anybody has like a temporary DTC. So there's some folks, like especially children who are on the spectrum or things like that, they often have to get reassessed every 5 to 10 years. So in that case, just keep an eye on things, because if your DTC drops off, then you would want to reapply. Like say yours you said it was for arthritis. Like let's say it wasn't a permanent.
It wasn't for my spinal cord injury at all. So
So
it just seems like the years between 60 and 65 especially are like you're in no man's land. There is no help for you except for DTC. That's it. And then when you're a senior, it's a little different because all the other things kick in, but really there isn't a lot of help for anybody after you're 60 years old. So people who are younger than 60, get on this. That's my advice. Because and if there's anybody listening who isn't disabled, start saving for your retirement, because it is so important. We had savings, but I mean, who knew that we were going to have to deal with disability like this? And it's expensive. Well, everybody knows it's expensive to deal with it. So.
Yeah, thanks, Roberta. And if you ever want to like reach out to me, if you ever had any questions about different supports that are out there, I mean, there are supports that are specifically laid out for seniors, like through different agencies and programs and things like that. So feel free to always, like, you're always welcome to reach out to me if there's something specific that you're looking for.
And
Okay,
Roberta,
thanks a
there
lot.
may be an option, it really depends, to get Canada Pension Plan disability benefits.
I had
before-
CPPD before.
Okay,
Yeah, I had those up until I turned 65.
okay,
But you have to realize too, that if you have CPPD, usually it takes a drop in amount when you start your OAS. So, yeah, so there's a whole lot of surprises ahead. And not all of them are good.
no, unfortunately, right? But it
Yeah.
sounds like you've made the right steps to try your best, right, Roberta?
Yeah,
And
that's all you can do. Yeah.
yeah.
James, did you have a question?
Yeah, hi. So looks like two witnesses for a will in Ontario at the same time, neither one of which can be a beneficiary. The next question I would have is, where does it go? Like, you know, people looking for the silly thing in case they find an older one and you got a revised one. I assume it could go to the executioner. Is that the right word? Executioner? No. What's the word?
Executor, close. So James, what I would recommend as a financial consultant, so you can provide something like that to us to keep on file, but I recommend for anybody, to whether you have a financial consultant or not, to have a folder ready with all of your paperwork, whether it's insurance, investments, pretty much anything, your will, your powers of attorneys, and make sure that your executor, or executrix, that's a female version, that they know where that information is upon your passing. And whether that's just a filing cabinet that you have everything kept in, it's something a lot of people don't think about, but it's really hard to search around through all these different companies, right? You'd have to go through someone's bank statement and try and find, you know, where different payments went and what happened here. So preparing as much as you can for your next of kin or your executor, I would say, is always a very valuable thing to do. Takes a bit of time on your end, but it really helps in the long run.
Yeah, that's great advice, Marissa. I mean, putting together the sort of, I mean, without sounding too morbid, but the like when I die sort of package of like your will and your passwords for online banking, like, you know, keeping it somewhere safe. Like I have a safe, I have things locked up in, like have all that somewhere. Make sure someone knows where the key is or the code is so they can access it. If you're a true crime junkie like Wendy and myself, you also have a in case I go missing file of anything, like how to find you, things like that. But anyways, that's another story. That kind of goes hand in hand with James's executor or what did he say? The executioner. Sorry, executioner. Yeah. Yeah. Wendy, did you have a question?
Yeah, just one quick question. I'm obviously have my RDSP with a financial institution. The only problem is if I want to change that financial institution to a different one, is it going to be a problem to move my RDSP over?
Nope,
Okay.
not an issue at all. So how that would work, Wendy, is you would have to contact a new financial advisor, see if it's a good fit for both of you. Typically, that's how it goes, right? And then you fill out some forms to open an account here, and you just do an RDSP transfer. So there's no taxable implications to moving to a new financial institution. You just got to sign some forms for it.
I would throw out the only caveat is because I went through it, and at first the RDSP was set up with a different financial institution, and my regular finance guy couldn't take it because he didn't have the licensing for RDSP or something. So there was a number of years that I couldn't consolidate it into one. They are now, but like I said, for whatever reason, I couldn't do it. But
I had the same situation, Randy, and I think that was when RDSPs were sort of like, people didn't know much about them, and a lot of financial institutions didn't have that licensing, and that exact thing happened to me. I had mine with my regular bank, and then when I moved it over to IG, it took a little bit to be allowed to do that, but now everything's there and it's like all in one place, which is great.
I should always mention there may always be a fee to transfer.
Yeah.
And that would be from your institution you're transferring from, not the receiving institution.
Yeah.
And I don't know what that would look like. Some places $100, you know, some places don't have any, but always good to consider if you are planning on moving it over.
Is there any final questions for Marissa before we say thank you? Well, we'll say thank you. This was amazing.
Awesome.
So much information. If anything else comes up, please feel free to reach out to myself or Marissa. I did put her email in the chat there. And if anybody's didn't get a chance to write it down or not able to, feel free to email me and I can share that with you. Yeah, or if you want any further information, those flyers or anything like that, we can pass any of that along to everyone. But we really appreciate your time, Marissa, and all your research and sharing your knowledge with us. And yeah, Marissa's the best. So thank you.
Thank you guys. It was really great. All the questions were fantastic. And if you have any more, just reach out to Sherry or myself.